We are talking about mortgage renewals and specifically what we can kind of refer to as the renewal tsunami that I would say has started already. When you look up things online about mortgage renewals, it says that, something, I'll confirm the stat in a minute, but something like 60% of mortgages in Canada are up for renewal in the next 2 years. And so what I'd like to talk about, and the two most important things really are, what does that financial landscape look like for people, and what is the emotional landscape? And there isn't always, an exact match between the two. Higher mortgage payments doesn't necessarily mean on its own that that's going to be more emotional for people. But yeah, we'll delve into it. But the mortgage renewal tsunami, what does that mean to people?
Well, I think on its head, it just means that from a bank's perspective, actually, what it means is there's a lot of renewals that are happening or maturities that are happening with mortgages all at once in this specific year, in the next 2 years. Because keep in mind, like a lot of mortgages that are taken are like 5-year cycles, right? Like 5-year mortgages is what the rates are for, somehow is the benchmark. Not that you can't get a 10-year mortgage, not that you can't get a 1 or 2 or 3. So when they speak about like the mortgage renewal tsunami, it's just a lot of Canadians and homeowners are going to be faced with renewals. And with that may come challenges, because if you look at 5 years ago where rates were, they were a lot lower than what they are. Like I think some people might have been even like close to 2%. And rates are at the very least double that today.
In some cases, lower than that. 5 years ago, so now we can talk about 5 years ago as the start of COVID. Whereas a few years ago when we were doing some of these recordings, it was like either during and maybe to the tail end of COVID, or it was kind of like right in the middle, depending on how old the recording is. Now we're 5 years beyond it. To your point, that's the typical cycle is most people, if they have the option, will do a 5-year term, so 5-year variable or a 5-year fixed.
Yeah.
And so now we're at the end of that. And so, yeah, so 60%, confirm the stats, so about 60% of Canadian mortgages are coming due for renewal. That's a massive amount. And if that's true, at least for those that took 5-year terms, they were looking at rates that were sub 2%.
Yeah, and actually, let's make a distinction very quickly, because I was on the receiving end of this. But for those people that are a little bit more of a shock as compared to those that had variable. So I've been on the variable, and anyone that's been in my situation has come to those like what we've known as trigger rates, where over this 5-year period, as rates were rising through Bank of Canada, eventually whatever the mortgage payment was wasn't sufficient to cover the interest. So then your bank gives you a call or sends you a letter and says, hey, it's not enough. We got to increase your payment. But they don't just increase it a little bit. They increase it significantly to account for future rate hikes. So people that have variable mortgages are probably less shocked by anything that's happening around renewal time, because they've already had time to adjust along the way. They've had their shocks. Whereas fixed rate mortgages, people with those payments are the ones that are going from whatever their payment is to potentially like 60% or 50% increase or double in some cases. So it is nerve wracking. And the interesting thing too is, well, some people, critics will say, well, they should have seen it coming. Like you had like 5 years or 3 years or 1 year out to kind of plan for this. But the truth is, everyone's human, and at the end of the day, you get used to what your bills are, your payments. So if you know your mortgage payment today is $2,000, even though you know in a year it's probably going to be 3 or 4, it doesn't change the fact that you have already allocated your money towards other lifestyle or bills or whatever the case may be. So yeah.
And a 5-year period is a long enough time frame where, though that payment is not permanent and forever, 5 years is enough time that you adapt your lifestyle within that 5-year period to your cash flow. So you know what's going to your mortgage and you know what's going to the other bills, and most other bills are also increasing and have done so already in most cases, car insurance and phone bills and you name it. And now you have the shock factor of your mortgage going up, and you might have known it this whole time, or at least for the last year. In anticipation, you're thinking, man, a year from now is going to be rough. Knowing that ahead of time, even a year in advance, isn't quite enough to avoid the shock of the reality of when that mortgage renewal comes, and it is maybe more than double, maybe not more than double, but let's say double what you're paying now. It's significant. It's going to hurt a lot of people.
And also, I'll be honest, some people and even myself are thinking, when the time maturity comes, maybe things will work out. Like, so even though you have a year, you're probably thinking rates will probably come down by then. The way that the market is going, or the economy seems to be, and just how everything is expensive. Man, you were telling me how Starbucks charges $7 for a frozen croissant. So, I mean, if you factor that into your bills,